Okay.
Hey guys, so I'm super excited. I have Mr. Josh Jelsing, an amazing lender here locally in San Diego. But today I'm going to speak to my agent friends as well as any of my friends out there thinking about buying, selling, because Josh, as we've discussed, one of the big headlines that we're going to see in 2022 is interest rates going up. And so today I really want to learn from you, Josh, on what is the difference between the Fed raising rates versus mortgage interest rates. And you've had lots of conversations with me over the years about this, but I'm really seeing that I need to clarify this not only for myself, for my agent friends, but for everybody else. So Josh, if we, from your ears to, or from your mouth to our ears, would you please help us make some sense? Because is that accurate to say that in 2022, we're going to see headlines that said the Feds raised their rates, and that, how does that affect? Like, could you kind of take us through this process and help us understand what the heck we're going to be talking about?
Yeah, absolutely. Phenomenal question. And I probably receive 50 phone calls, 50 emails every single time the Fed announces they're going to raise the rates, because they get clients that go in and just panicked. I need to refinance, or I need to lock in my loan before they raise the rates.
Right.
And the Fed raising the Fed fund rate, or prime, has nothing to do with actual mortgage rates initially. In fact, historically, you can go back and look at every single one of the graphs. And what happens is when the Fed raises their rates, they're raising that rate to counter inflation. And if they can counter inflation, then actual interest rates will dip down slightly when the Fed raises their Fed fund rate. You'll see a slight dip in mortgage rates, and eventually mortgage interest rates will begin tailing the direction of the federal fund rate, just because it's a healthy economy. And usually when there's a healthy economy, rates start ticking back up. So
all right, so that's a lot. Yeah, I'm gonna have to unpack that a little bit, but
right.
So I'm glad that we're doing this, because this is so interesting to me. So the Fed fund rate, and this, please help me clarify this. I believe that this is what the federal government, the Federal Reserve, is basically, here's the rate of the money that they're lending to banks, right? Is that an accurate statement? I don't like the Fed's rate, when they deliver it, they're not delivering it to homeowners. It's like they have nothing to do with the homeowner relationship.
Right.
It's the relationship that the banks or lending institutions have to do with. So could you just kind of give us some, I just don't understand how the heck that game is played out, right?
So the Fed, there's a lot to it, and you can go way into the weeds, but we're going to keep it topical, right, and superficial. And so the gist of it is this: the Fed fund rate actually has nothing to do with mortgage rates. So what the Fed fund rate is bank to bank lending, the overnight rate that they lend to each other. The direct effect is going to be your short-term loans, like business loans, credit cards, auto loans. Those type of things are more of a direct effect. But your Fed fund rate really has to do with bank-to-bank lending, and that's it.
Right. So and I think that's what I learned is, like, it doesn't really have a direct impact on you as a mortgage broker providing me my loan, right, for the refinance and the cash out that we did. So thank you very much for that. For all my friends out there, Josh is responsible for that amazing, beautiful pool that we have. So thank you very much, Josh, right? And the 1/4 point reduction in our 30-year fixed loan. So thank you.
There we go.
But so, yeah, so just for all of us agents and friends out there, the Fed raising rates on the Fed fund or prime has nothing to do directly with mortgage interest rates as of today. So can you explain kind of what you meant by this trailing and twisting and turning? What now take us to the next level?
Absolutely. Can I do that share screen really fast?
Sure, yeah,
It's really good. We're going to do this for half a second. I think it's a really good point for everyone to understand. So share that thing so you can see the graph. And what you're looking at when this graph comes across, can you see that?
Yep, got it.
This is the mortgage-backed security bond market. This is what all mortgage rates are based on. You're going to hear the 10-year treasury, but the real controller or index behind 30-year fixed rate loans, which is all your government stuff, Fannie, Freddie, FHA, VA, right? The real controller is this mortgage-backed security bond market. So when people talk about rates going up because of the Federal Reserve, What they don't realize is look at this graph. Rates go up and down nonstop every single day. The Federal Reserve has been flat for the last, what, 2 years at 3.25? I'm probably wrong on the dates, but it's been quite a while since the Fed has adjusted their rates. Well, if the Fed had anything to do with mortgage interest rates, then why is this changing literally every day? This is called a Japanese candlestick graph, right? And every single candlestick represents one day. I'll do the 1 month so you can kind of get a better idea. So this is daily trading. Daily trading is based on economic news, world data, world events, things like, this is drastic, but 9/11. I remember when 9/11 happened, the market just shifted. The graph just fell off the map. So there's what controls mortgage rates is going to be your economic data, your employment numbers, those types of things, world events. That's what controls mortgage rates. Your Federal Reserve, I'll stop sharing my screen now. Your Federal Reserve is simply for the bank-to-bank lending. And when the Fed raises their rates, I'll say it again, they're doing that to combat, especially right now, they're doing it to combat inflation. So if inflation is the arch enemy and actually helps, or inflation causes rates to go up, if they're raising the Fed fund rate to stop inflation or slow down inflation, then that'll actually see a slight decrease in mortgage rates. And then eventually, as the Federal Reserve is raising their rates, the mortgage rates will increase as well, only because it's a strong economy and that's what interest rates do. Does that break it down a little better?
Yeah, that's definitely, it's becoming more and more clear. I think I'm almost there. Let me ask a couple more questions, and we should have done this live for all my agent friends and friends out there in the world who want to buy and sell, so we can ask Josh some questions. Make sure you guys find all of his contact down below. Give him a call, send him an email. He's super slam busy. As I told all my friends, Josh, last year, I was like, look, if you don't have a good relationship with a Rockstar loan broker, loan officer, that is a huge problem, because they're so busy that the best ones are going to be having a tough time communicating with you if you didn't have a good relationship. So good, quick lesson out there. So here's the deal. So Fed rates go up between bank to bank, but then mortgage, and that's usually on because of inflation. And as we all know, in inflationary times, home prices go up.
Yeah.
And so us real estate agents and homeowners, we actually kind of like it, because the value of our home is dramatically going up.
Yep.
But that means that there's a whole nother economic indicator going on that is sending a red signal that's not good. So the mortgage rates go up for Federal Reserve to banks. And so that's there to tame a strong economic signal, which is, again, not terrible, not bad news at all.
No, not at all.
So, but you were showing me this. Mortgage, what was that thing? The bond.
Mortgage-backed security bond market. The
Mortgage-backed
MBS.
security bond market.
Yep.
So is it safe to say, and please correct me if I'm saying this wrong, the mortgage-backed security market is more of a free open market, right? It's based upon supply and demand of
100%.
these bonds that were created, mortgage-backed securities, which is either a compile of loans that were packaged up by loan brokers like yourself, and then there are institutions that want the interest on that and are willing to buy it. Is that kind of
it's a high demand? The rates usually going down. You're 100% right.
Yeah,
absolutely.
So as the demand for more kind of loans as investment tools, safe, secure 30, 15-year secure loans, the more demand there is in the investment world for those, does that mean that our home loan interest rates goes down?
Exactly. Yep, exactly. The more demand there is for loans, the lower the rates will go. And what we're seeing right now too, and this is, again, getting into the weeds, I apologize.
No,
but the Federal Reserve came out and said that they're going to stop reinvesting and buying all of their mortgage-backed securities. So they're tapering down. It's a quantitative easing in effect. If you guys remember back in the last crash, there was quantitative easing 1, 2, and 3.
Yep.
Well, they kept that bond buying program going, and now they're actually reducing literally billions of dollars of purchases of bonds each month. And again, starting to see rates take up a little. In fact, the National Association of Mortgage Bankers, National Association of Realtors, Zillow came out with their report, Realtor.com came out with their report, and they're forecasting for interest rates in between all these different, big hitters. They're forecasting that rates are going to go up anywhere from by the end of 2022 to 3.3%, all the way as high as 4%. And now that's a big range. It's almost a 3/4 point range. But that's what the predictions are coming out at from all the major entities.
Yeah, and so let's talk about that, because I was on my brother Tom Ferry's and the Keeping Current Matters, kind of This Week in Housing, and we looked at that chart on Tom.
Yep.
It's on it should be on YouTube, or it'll be on the Facebook page. And so one of the things that we were discussing, and we looked at that chart, and it showed that the Mortgage Broker Association was projecting, in 2020 rates would get to Realtor.com, Zillow, right? We kind of went down the line of all of these guys and what their projection was, which was very vast, right? It was, 3.3 to 4. So, but I want to address this thing about the tapering of the Fed buying these mortgage-backed securities.
Yeah.
Right. And so basically what you're saying is one of the big buyers to the mortgage-backed security bond market has been the Federal Reserve.
The
and
primary buyer.
So it's like, if we take away this buyer, then the demand on these mortgage-backed securities is going to go down a little bit, which, so help me understand kind of how that works, right? Like, because I am hearing this, right? Like I'm listening to this Danielle DeMartino Booth, who I like a lot, trying to understand the Fed and fiat and money and all this BS, but like, I still don't understand that, dude. So can you clarify, like, if they stop buying those mortgage-backed securities, what does that do to the supply demand curve? And why is that an indicator that rates would be projected, mortgage rates would project to go up?
Yeah, I think it's one, it's so incredibly complicated, and I've heard so many predictions and forecasts already.
Right. Me too.
Never know exactly where it's going to go, but one of the ideas is that by reducing the amount of purchases that the Fed is buying for the bonds, the amount of bonds being purchased by the Fed, it'll create opportunity for others to come in and fill that void. They buy a lot in bonds, so who knows if that's really going to happen. But if they're buying less and they're raising their Fed fund rate, the whole idea is that it's going to counteract, and you're not going to have rates just shooting up. They're going to be able to do it in a controlled manner to keep the economy from either going into recession or maybe not going to the recession as badly. So it becomes such a complex situation that if you have a loan officer from San Diego trying to break it all down, maybe it doesn't go as well.
Yeah, but still,
it is. There's so much that's being done at such a high level with buying these mortgage-backed security bond markets, and then now reducing the amount of purchases to try to control the rates. It's a lot.
Okay, let's go to the next level. Okay. So, and if you're bearing with us, guys, we love you and thank you so much. Right. And if you're, so here's this guy right here. I have Ray Dalio's up there, and then I have this one that says 2% mortgage rates right there. That was a economic report that was published in February of 2000, and I think it was 18. 2000, no, maybe February of 2018 or 17. I think it was 17. Yeah. So he was projecting 2% mortgage rates. And this was, Bruce Norris, one of my favorite kind of California local investor economic forecasters. So he's on record. And then we ended up seeing that happen, but not for a couple of years. How does that happen, Josh? You know what I mean? Like,
that's like a perfect storm.
Because so now, listen, I was just listening to his latest on his YouTube channel. I was just listening to so Doug Duncan of Fannie Mae, one of the chief economists for Fannie Mae, and then Sean O'Toole, the co-founder of Property Radar. Sean said something, and I was like, "What?" So Sean said, "I could see 1% mortgage rates on a 40-year loan." And I was like, the hell is he talking about? How is that even possible?
Yeah.
Now, that was the same statement that I made when Bruce Norris said, I could see 2% mortgage rates.
Yeah.
And they got there.
Yeah.
And many of your clients refinanced and or got loans in the twos.
Yep, 100%.
So
At the best, in August of 2021, and again, it's for a short amount of time because you hit these all-time bests or all-time lows, whatever you want to call it. And then it's only there for 24 hours. And the people that happen to call in during that time, they're able to take advantage of it. And there's no way to forecast or know when it's coming, because sometimes in our industry, we have it a saying, it's all rates go up like a rocket and down with a parachute. So you just don't know when these super low rates are going to strike. You might have an idea, but nobody thought they're going to be locking in a 30-year fixed rate loan at 2.375, which is what we were doing for a couple of days on a conforming loan amount for a Fannie Freddie loan. It was amazing.
But my question is how does that happen? Because when Sean said that to Doug Duncan, Doug said something and he was like, well, he said like something like, if this occurs, I could see that occurring.
Yeah.
So he basically left a door open that there's a possibility that this could get there. Now, I'm thinking to myself, okay, for us here in California, we're like screwed, right? Because the cost of our homes is so high, to be able to buy in is ridiculous. And if interest rates get to 4.5, right? Just like in the end of fourth quarter of 2018, we saw a softening in the market. And then in 2019 went back down again, and the market, zoomed up again, even though it's kind of a soft year. So I'm kind of like, this is the thing, is like, do you have any words of wisdom to wrap this bad boy up on, like, how do we, the average real estate agent view this or try and think about this? I just don't want to get, disturbed by headlines. I don't want my customers bugging you on a headline that I could have answered for them. So this video will help.
Yeah.
But I'm just curious, do you have any final words on how these darn mortgage interest rates move on this free market? And like, what's your opinion
I'll
about it?
tack on to what you're saying. So I remember when we were doing rates that were at 5%, they're like, oh, this is the lowest they'll ever go. At 4%, same thing, 3%, 2%. And for every single new record, it sets another bar, whether it's a ceiling or a floor, right? And so, and remember just 2-3 years ago, there's a lot of the European countries that were having a negative rate.
Right.
Their Federal Reserves were negative rates, which tells you that there's a possibility for that with us as well. And I think with the mindset of people, you'll say like, I'll quote someone a 3.25 rate. They're like, oh my gosh, that's so high. What are you talking about? 3.25? That's ridiculous. But that's like the new high and new lows. So depending on how the economy works out, because I'll say this, and this is a great takeaway for anybody listening. Interest rates love negative economic news. They do. They raise when things are good. They improve, or they go up when there's good economic news, and they go down when there's bad economic news, right? So depending on this economy and wherever the leadership of today takes this thing, whatever happens, if we go into a recession and inflation is no longer a concern, we're going to see, my prediction, my bet would be, we would end up seeing new lows, a new record lows, because we've already been down to this record low. So now the next record low is going to be down here. And I could 100% see that coming.
I'm in the same boat, that conclusion, and that was really helpful. So can I summarize and then clarify for me and for all the listeners, for my real estate agents out there? Because what you're saying is if we see the economy going down, that means less investment money is going towards stocks, less investment money is going towards other financial assets. And a mortgage-backed security in the US 15-30 year is a little bit more of a safe and secure investment.
Absolutely.
So the money flows in that direction, creating more demand on mortgages, and then creating a lower pressure on the right, on the interest rate.
Absolutely.
Is that a safe statement to make?
100%. People take their money out of the volatility of the stock market and they place it into the security of the mortgage-backed, security bond market.
Bond market.
That's going to take the money, flood it over to here, maybe fill that vacuum that the Fed left open, and then you can see rates going down again. But it's going to take the direction of the economy is really going to be the driving force of that.
Got it. So I think the general think this is really helpful for me, by the way, and that was very clarifying. So really what we're talking about kind of is, and this is where I was getting my hunch, is why I need to do this video with you and all my agent friends out there. You need to either do a video with Josh for your community and or, talk to your mortgage-backed lender and have this your lender and have this conversation with them. And for all my friends in San Diego or in California, give Josh a call for your own home loan. That's who we used. Okay, but here's the deal, dude. So what I hear you saying is, and this is kind of what I was getting, my brain was wrapping, is like kind of as this recessionary pressure comes in, then yes, interest rates will probably most likely go down. But as we are really steaming forward with the economy and inflation, we could really see them kind of rising. So it has nothing to do with the Fed fund rate, which we're going to see in the headlines, and everything to do with more of a economic indicator is really what's going on.
Right. Yep, absolutely.
Safe.
And who knows how many times you're going to raise that Fed fund rate, but every single time it comes out, they push that in the news. In fact, even the big news companies, CNN, Fox News, they get it wrong. They'll say Fed's raising their rates, mortgage rates are going up, and it's just not the case.
That's exactly. Thank you, Josh. You're the man. Thank you so much for your time. We'll end it on that. And thank you. I'm a lot smarter spending some time with you today, so I appreciate you. And hope you guys have a great time snowboarding up in Park City. So if you guys are up in Park City over the holiday, Josh will be up there on the slopes with his sons shredding it up. So see you later, man. Have a happy New Year.
Thanks, guys. Have a great night. Happy New Year to you too.
Hold on.